For most people, that sentence sounds simple, even boring. Another headline in a world flooded with market noise. Another price chart going up. Another asset having its moment. But for those who understand monetary history, silver making a new all-time high is never just about price. It is a signal. And like all real signals, it does not announce itself loudly. It does not come with certainty. It does not wait for permission. It moves quietly, while explanations scramble to catch up. The mainstream explanation is already everywhere. They say silver is rising because of demand. Industrial demand, green energy demand, solar panel demand, electric vehicle demand, investment demand, demand. It sounds logical. It sounds safe. It sounds familiar. And that is exactly why it is misleading. Because demand does not explain timing. Demand does not explain acceleration. Demand does not explain why silver moves suddenly, violently, and out of proportion to its underlying industrial use. Silver does not behave like copper. It does not behave like oil. It does not behave like wheat. Silver behaves like money. And money does not move because people suddenly want more of it. Money moves when trust breaks. To understand why silver just hit an all-time high, you must stop looking at factories and start looking at balance sheets. You must stop looking at consumption and start looking at confidence. You must stop asking who is buying silver and start asking who is losing faith in everything else. Because silver does not rise in strong systems. It rises when systems strain. This moment did not begin with silver. Silver is not the cause. Silver is the consequence. THE first T, MESTK confuse PI she belu ITH veil E. Modern finance has trained people to think in prices. Stocks have prices. Currencies have prices. Real estate has prices. Commodities have prices. But price is not value. Price is what you pay. Value is what you trust. In stable monetary systems, price discovery happens gradually. Changes reflect productivity, innovation, and real economic growth. But in unstable monetary systems, prices do something very different. They stop measuring value and start revealing distortion. Silver's all-time high is not a reflection of its usefulness. It is a reflection of monetary imbalance. The question is not, why is silver going up? The real question is, what is everything else going down against? Because silver has not suddenly become more valuable. The currency measuring it has become weaker. A BRIEF TRAT MUS POPLENEVR SHETAR. Silver is one of the few assets in the world that is both a commodity and a monetary metal. This dual nature confuses analysts. When silver is cheap, it is treated like an industrial input. When silver explodes, it is treated like a speculative anomaly. In reality, silver is neither. Silver is a monetary pressure gauge. It reacts not to demand curves, but to monetary stress. Not to consumption cycles, but to confidence cycles. Historically, silver does not peak at the start of economic booms. It peaks near the end of monetary credibility. This has happened before. Many times. And every time, the explanation was wrong. Do HYTHEDMD stur ALWIS a PERS 8 THTOP. Here is a pattern that repeats throughout financial history. First, monetary distortion builds quietly. Debt expands. Liquidity increases. Interest rates are suppressed. Second, assets begin rising unevenly. Stocks first, real estate next, then commodities. Third, precious metals break out. Gold first, silver later. And finally, after prices move, explanations arrive. The public explanation is always demand. Why? Because demand feels natural. It avoids blame. It avoids questioning the system. It avoids questioning money itself. No one wants to say, the currency is failing, the debt is unpayable. The system requires constant intervention to survive. So they say people just want more silver. But demand did not suddenly appear. Solar panels did not suddenly get invented. Industrial use did not suddenly double overnight. What changed was not silver. What changed was the financial environment surrounding it. THENV CBLE FORC B IND SILVIARS MOV. Every modern market moves on liquidity. Liquidity is not money. Liquidity is confidence that money will be there when needed. Central banks do not print value. They print liquidity. And when liquidity becomes unstable, capital searches for anchors. Silver is one of those anchors, not because it yields, not because it grows, but because it cannot be created at will. When central banks expand balance sheets, silver does not respond immediately. It waits. It waits until participants realize the expansion is permanent. It waits until tightening becomes impossible. It waits until credibility fractures. Then it moves fast. Silver's all-time high is not a reaction to easing. It is a reaction to the realization that tightening failed. THEFED, GUITUT every monetary era has an authority, an institution trusted to manage stability, to smooth cycles, to prevent collapse. But no authority controls outcomes. They only delay consequences. When delays compound, distortions grow. Interest rates stop reflecting risk. Debt stops reflecting productivity. Markets stop reflecting reality. At that point, prices lose meaning. Silver becomes relevant again, not as an investment, but as a reference to something outside the system. Bush CLVR MOVA Slyatar Han GULD. Gold is the first responder. It reacts to macro signals early, to currency debasement, to geopolitical risk, to reserve confidence. Silver lags, not because it is weaker, but because it is more explosive. Silver is smaller, less liquid, more volatile. When silver moves, it means gold has already spoken, and the message was ignored. Silver's ATH is not the beginning of a story. It is confirmation. Confirmation that monetary stress has moved from theory to price. THE sell VR market IS now TFRE. This part makes people uncomfortable. Silver is not traded like normal commodities. It is heavily financialized, highly leveraged, dominated by paper claims. The physical market is small. The paper market is massive. For years, this structure suppresses price signals. But suppression does not remove pressure. It concentrates it. When pressure escapes, it does not move gradually, it gaps. Silver's all-time high is not a smooth breakout. It is a release. No het t haste mens, and o het it do yes nout. This is not a call to buy anything. This is not a prediction. This is an observation. Silver at an all-time high tells us something important. The monetary system is under visible stress, not collapsing, not ending tomorrow, but straining. And strained systems leak signals before they break. Silver is one of those signals. Silver has not always been treated as a commodity. Its role as money stretches back thousands of years. From the earliest coinage in Mesopotamia and Lydia to the medieval European silver thalers, silver has consistently functioned as a reference point in economies, a store of value, and a hedge against uncertainty. What distinguishes silver from other commodities is its dual identity. Unlike wheat, oil, or copper, silver is both a tangible industrial input and a monetary anchor. It is durable, divisible, and widely recognized. Throughout history, whenever governments or monetary authorities overextended their control of currency, silver prices responded, often years before the collapse became apparent in ordinary commerce. Consider the 16th century Spanish Empire. Vast quantities of silver flowed from the Americas, inflating prices throughout Europe. While the empire celebrated newfound wealth, underlying fiscal instability grew. Price spikes in silver were a signal to the savvy, monetary expansion was underway, yet the broader system was overstretched. The public only noticed the consequences decades later in economic dislocation and state bankruptcies. In the 19th century, the U.S. faced the free silver debate. Advocates for silver coinage argued that increased access to silver money would democratize credit, but opponents warned that unrestrained silver issuance could undermine monetary stability. In both cases, silver functioned as a benchmark for confidence. Its price reflected trust, or the lack thereof, in the broader currency system. History consistently demonstrates that silver reacts to monetary pressure before industrial demand accelerates. When fiat currencies are weak or debt levels are unsustainable, Silver is not a speculative anomaly, it is a diagnostic tool. Its fluctuations reveal hidden tensions in monetary structures long before they manifest as inflation or financial crises. Fiat QRNSIE SANDSYSTMIC STIRS. Modern economies operate primarily on fiat money. Unlike commodity-backed currencies, fiat systems rely on trust. Trust that governments will honor their obligations. Trust that central banks can maintain liquidity. Trust that debt can be managed without destabilizing the system. Fiat money is flexible, but this flexibility is double-edged. Authorities can inject liquidity, suppress interest rates, and extend credit indefinitely. In the short term, these interventions stabilize markets. But in the medium term, they create imbalances that ripple through asset classes. Silver is particularly sensitive to these imbalances. When confidence falters, silver surges, not because of industrial need, but because it represents a tangible check against monetary abstraction. Every expansion of fiat credit carries a shadow. Market participants may remain unaware until stress accumulates. This latent stress is why silver moves faster once signals become visible. It reacts to the recognition that liquidity support is insufficient to maintain real value across financial markets. Sirenturel BNKS AND Cure EMCY Sejimenels. Central banks are the ultimate arbiters of liquidity. Their policies shape interest rates, credit availability, and the public perception of currency stability. However, their actions cannot fully control market psychology. When balance sheets expand excessively or unconventional monetary tools are deployed, the system becomes more fragile, not less. Silver responds to these signals with clarity. While stocks and bonds may be influenced by sentiment, speculative flows, and policy promises, silver reacts to the underlying reality, finite supply, and tangible value. It does not rely on confidence in corporate earnings or government solvency. It reacts to the erosion of trust in currency itself. THE light movimiento of CLVR. Silver often lags behind gold. Gold is the first asset to reflect macro stress, signaling broad systemic risk. Silver, by contrast, accumulates pressure over time due to its smaller market size and dual function. When it finally moves, the surge is swift and pronounced. It confirms what gold hinted at weeks or months prior. Monetary credibility is compromised and conventional measures may no longer suffice. This pattern has repeated across centuries. From the Spanish Empire to modern central bank interventions, silver serves as a trailing indicator of monetary strain. It's all time highs are rarely the start of a story. They are confirmations that previous signals were overlooked. THE Papar Mar Kate VS PHYS IXL CLVR. Modern silver trading is dominated by paper contracts. Futures, options, ETFs, and other derivatives constitute the majority of silver transactions. Physical silver exists in far smaller volumes. This structural imbalance suppresses price signals, masking the real degree of stress in the system. When pressure becomes unbearable, suppressed markets react explosively. Silver's all-time highs are not gradual climbs. They are releases of pent-up tension, exposing the fragility of paper constructs. Investors observing these moves are witnessing more than price change. They are witnessing a system that has been constrained artificially for decades, now releasing its pressure in real time. Debt is not inherently negative. Economies thrive on borrowed capital, provided it is productive. But debt becomes dangerous when it accumulates faster than the economy's ability to service it. Modern economies operate with layers of debt, government debt, corporate debt, consumer debt, and financial derivatives built atop each. Leverage amplifies these risks. A small shift in market confidence can cascade through leveraged structures, magnifying losses and volatility. Silver, in this context, functions as a barometer. Its price movements reveal when leverage is extreme and systemic stress is approaching. Historically, each financial crisis has a familiar pattern. Initially, expansion appears benign. Credit flows freely. Asset prices rise. Policymakers are lauded for stimulating growth. But behind the scenes, balance sheets expand with hidden risk, and vulnerabilities accumulate. Silver and gold, though small in market share, react to this pressure because they are not products of debt. They represent tangible scarcity and value outside the fiat framework. INFLUTION narrower ADIVIS and DESTIRATION. Another critical element is inflation perception. Policymakers, economists, and media often emphasize inflation or deflation to frame public understanding of the economy. These narratives are powerful, but sometimes misleading. They shape expectations and can distract from deeper structural problems. Silver reacts not merely to consumer prices, but to the underlying erosion of currency purchasing power. When inflation is understated, or the money supply expands without immediate visible price effects, silver prices begin to move in anticipation. It reacts to latent risk, not immediate consumption metrics. DRI VIE market TSTR UCTUR. The modern silver market is complex and highly financialized. Paper contracts, futures, ETFs, and swaps dominate over physical silver. This creates both opportunities and distortions. Derivatives allow exposure without ownership, but they also conceal systemic risk. When leverage is high and market participants misinterpret signals, sudden shifts in confidence can lead to rapid price changes. Silver, constrained by paper markets, can leap unexpectedly, signaling systemic tension. The physical market, smaller and more tangible, acts as the anchor. It represents the real, scarce asset against which all paper claims must eventually reconcile. When price moves in physical silver, the signal is unmistakable. The system is under stress, and trust in paper structures is fragile. Selvar ANGLD ANTRTON. Silver and gold do not move in isolation. Their relative movement offers insights into monetary confidence. Gold is often the first signal, reflecting broad systemic risk. Silver, more volatile and less liquid, reacts once the market internalizes these risks. When silver outperforms gold sharply, it indicates acute stress in liquidity, leverage, or currency confidence. Such divergence has historically preceded major market dislocations. PSYCHOLOGIXL FACITUARS EINLAT CYCLE movimentis. Markets are influenced not just by fundamentals but by psychology. Late cycle movements in silver reflect collective recognition that the system has reached an extreme state of imbalance. Speculators, hedgers, and investors begin to act simultaneously, creating feedback loops that magnify price action. Behavioral finance teaches that human response to scarcity and risk can be nonlinear. In silver, these dynamics manifest as sudden spikes, volatility, and price gaps. Understanding psychology is key to interpreting why silver can jump dramatically even in the absence of new industrial demand. Cassi studi eis crisis. In the 2008 financial crisis, silver initially lagged gold but surged as monetary authorities expanded liquidity. Paper markets temporarily suppressed signals, but once leverage became unsustainable, silver reflected the systemic stress. Similarly, during historical periods of fiat instability in the 20th century, silver reacted after gold confirmed currency weakness. In each case, the narrative offered to the public emphasized industrial demand or speculation, masking the real forces at play. Understanding silver's movements requires a historical perspective. Across centuries, monetary failures have followed similar patterns, each time highlighting the importance of tangible assets as systemic indicators. Silver, along with gold, consistently functions as a signaling mechanism when fiat or credit-based systems begin to fracture. One of the earliest documented cases is the collapse of the Roman monetary system. As the empire expanded, debasement of currency became common. Silver coins were increasingly diluted with base metals, undermining public trust. Inflation and economic dislocation followed. Silver's intrinsic value, however, remained constant. Observers at the time could have used silver holdings as a gauge of underlying fiscal instability. Similarly, during the 17th century Dutch and English experiences with monetary expansion, silver's role as a hedge against inflation and currency devaluation became evident. When governments issued more paper or credit-backed money than could be supported by trade and production, silver prices increased relative to fiat money. Investors and merchants who recognized this early could anticipate shifts in market confidence and liquidity. The 19th century further illustrates silver's signaling capacity. The Latin Monetary Union, a system attempting to standardize gold and silver coins across Europe, encountered severe strain as nations manipulated silver and gold ratios to their advantage. While official narratives celebrated monetary standardization, silver movements indicated underlying imbalances. The metal acted as a precursor, showing that systemic confidence was fragile. The 20th century introduced new dynamics with the advent of fully fiat currencies. After the abandonment of the gold standard, silver, though no longer official money, retained its role as a hedge against currency debasement. During periods of monetary expansion, such as post-Dewey Reconstruction and the 1970s inflationary era, silver prices surged in anticipation of currency devaluation. Each spike served as an early warning of systemic stress. Stem-C leverage and sell VR. Modern financial markets operate with levels of leverage unprecedented in history. Leverage amplifies both growth and risk. Credit derivatives, repurchase agreements, and structured financial products allow institutions to control positions far beyond their actual capital. In such an environment, silver becomes a reactive instrument. Its movements reflect the unseen accumulation of risk throughout the financial system. When debt structures become overextended, the ability of institutions to honor obligations is compromised. Paper silver, in particular, is subject to high leverage, and sudden recognition of overextension triggers rapid price movements. Physical silver acts as the anchor. These interactions create sharp divergences between paper contracts and physical markets, producing volatility that traditional commodity analysis cannot explain. Einaflation narrate vis and URENCY confidence. Narratives surrounding inflation often obscure the real drivers of silver price movements. Policymakers and media may emphasize CPI figures or commodity-specific trends, but these metrics do not fully capture the erosion of currency value caused by systemic debt expansion. Silver, unlike fiat-denominated assets, reacts to the real purchasing power of money. When central banks expand balance sheets and when trust in currency begins to weaken, silver prices reflect the latent risk long before inflation becomes visible in consumer goods or services. It is an anticipatory signal, not a reactive measure. Comparative VALYSIS, OFSEL VR spike ES. Historical silver spikes reveal patterns that repeat across centuries. Each spike corresponds to moments when trust in fiat or credit-based systems diminishes, either due to excessive monetary expansion, geopolitical shocks, or debt overextension. During the 1970s, the Hunt brothers attempted to corner the silver market. While their actions are often cited as the reason for price surges, the broader context was systemic monetary strain. Inflation was rising, dollar confidence was weakening, and silver became a refuge. The Hunt brothers merely magnified a trend already driven by macroeconomic forces. More recently, the early 2000s and the post-2008 financial crisis period demonstrated the same pattern. Central banks injected liquidity to stabilize markets, but trust in currency remained tentative. Silver responded first to these unseen pressures, signaling stress that would only later manifest in broader markets. PSY psychologique and behaviorales drivers. Investor psychology plays a critical role in late cycle silver movements. Herd behavior, risk perception, and scarcity mentality amplify price reactions. Late cycle surges in silver are often driven by collective recognition of systemic imbalance. Once the market internalizes the limits of liquidity and leverage, participants rush toward tangible assets, creating feedback loops that drive price accelerations. Behavioral finance teaches that scarcity and fear are nonlinear drivers of market activity. In silver, these forces create sudden and extreme price moves, often misunderstood as speculative anomalies. Historical evidence shows that these moves are consistent signals of systemic stress, not random market behavior. Modern financial markets have evolved into complex ecosystems dominated by derivatives, paper contracts, and sophisticated instruments that often obscure underlying scarcity. Silver, despite its tangible nature, is deeply intertwined with this paper market, which significantly impacts price behavior. Tia pop R market errant price su PPRS own. Paper silver includes futures contracts, options, ETFs, and other derivatives representing claims on silver without physical delivery. The sheer volume of these contracts often exceeds available physical silver, creating a structural imbalance. This discrepancy can suppress silver prices artificially, masking the real level of demand for the metal. Historically, when this suppression reaches its limits, sudden surges occur. The market cannot maintain prolonged artificial pricing against physical scarcity. These surges are often misattributed to speculation or short-term demand shifts, but in reality, they reflect structural imbalances in leverage and confidence. Derivatives and SYSTEM risk. Derivatives amplify both opportunity and risk. Financial institutions can take positions far beyond their actual capital, creating leverage that magnifies market stress. A small shock in confidence can cascade through these structures, impacting not only silver but interconnected asset classes. Silver's reaction to these pressures serves as a warning. It is one of the first assets to react to systemic imbalances, given its dual role as a commodity and monetary metal. The paper market magnifies this effect by concentrating risk and delaying the full recognition of scarcity, leading to pronounced volatility when the market adjusts. INTR ATH GLD A&D Obel Res Arvius. Silver does not move in isolation. Its relationship with gold and global reserves provides critical insight into systemic stability. Gold, historically recognized as a reserve asset, often signals early stress in the monetary system. Silver, being more volatile, confirms these signals later in the cycle. Central banks and sovereign reserves hold gold as a stability mechanism, but silver often exists outside official reserve frameworks. This gives it freedom to reflect market sentiment unencumbered by institutional constraints. When silver prices spike relative to gold, it indicates acute systemic stress and declining confidence in fiat mechanisms. Global reserve interactions also influence silver indirectly. When countries diversify reserves or hedge against currency risk, silver can act as a proxy for broader monetary adjustments. Its price movements reveal shifts in global capital flows, liquidity constraints, and emerging stress points within international monetary systems. BAZORL and PSYCHOLOG cell IMPCTS. Market psychology compounds these structural pressures. Investor behavior, scarcity perception, and herd mentality drive exaggerated reactions once systemic signals become clear. Silver's volatility reflects not just tangible scarcity, but also collective sentiment around monetary trust. Late cycle surges in silver often correspond to moments when confidence in conventional fiat and leverage systems erodes. These moves, while seemingly abrupt, are consistent with historical patterns, confirming silver's role as a diagnostic tool rather than a speculative anomaly. Kesistodis of Madar Volatility. During the 2008 financial crisis, silver lagged gold initially, but surged dramatically as liquidity injections revealed structural vulnerabilities. Paper market dynamics temporarily delayed recognition of true scarcity, but once leveraged positions were reassessed, physical silver responded sharply. Similarly, in the early 2020s, global monetary expansion, combined with fiscal interventions and derivative market growth, set the stage for silver to act as a stress indicator. Sharp price movements reflected not industrial demand, but recognition of systemic strain, consistent with patterns observed in historical crises. Silver's behavior during late cycle market conditions offers some of the clearest insights into systemic monetary stress. Throughout history, Silver spikes occur not as random events, nor purely as responses to industrial demand, but as reactions to a culmination of macroeconomic and psychological pressures. UNDRLENG Meteoro Ikiona I Tiragigieras. Several consistent macroeconomic triggers precipitate late cycle silver movements. Excessive monetary expansion. Central banks expand balance sheets in response to crisis or growth targets. While intended to stabilize markets, prolonged expansion can lead to diminishing returns, eroding confidence in fiat currency. Debt accumulation beyond servicing capacity. Governments, corporations, and individuals collectively amass debt beyond sustainable levels. This increases vulnerability to interest rate shocks, liquidity constraints, or default events. Currency depreciation. When a national currency loses value relative to other currencies or tangible assets, investors seek protection. Silver, unlike many fiat assets, is not directly manipulated by government policy and retains intrinsic scarcity. Liquidity stress in financial systems. Even when money supply increases, liquidity can become constrained due to risk aversion, capital flight, or market segmentation. Silver serves as a transparent indicator of these pressures, as its price rises when conventional liquidity mechanisms fail. Systemic leverage points and derivative overextensions. Complex derivative structures amplify market instability. Silver often reacts dramatically when leveraged positions must be reconciled, exposing hidden systemic vulnerabilities. Hesestua IKL Pitar is Oflet CYCL East. Late cycle silver spikes are not anomalies, they are consistent across eras. Examining history offers predictive insights into their causes and potential consequences. Case study 1970s silver spike. The Hunt brothers' accumulation of silver is often cited as the reason for price surges. However, the underlying driver was systemic, rising inflation, weakening dollar confidence, and global monetary instability. Silver's surge reflected these broader pressures rather than isolated speculation. Case study 2008-2009 financial crisis. Initially, gold prices reacted to systemic risk, with silver lagging. As liquidity interventions and balance sheet expansions continued, silver prices surged, highlighting leverage constraints and market stress that paper markets had temporarily masked. Case study early 2020s monetary expansion. Global fiscal and monetary interventions combined with derivative market growth created systemic pressure. Silver's movement during this period confirmed historical patterns. It surged in anticipation of currency depreciation and liquidity constraints, signaling systemic risk rather than industrial demand. Central bank interventaio ons and market sigimales. Central banks influence silver indirectly through policy actions affecting money supply, interest rates, and liquidity. Quantitative easing expands balance sheets, increasing nominal liquidity. Over time, participants recognize that liquidity does not equate to value preservation, prompting movement toward tangible assets like silver. Interest rate adjustments. Low rates encourage leverage but reduce yield on fiat-denominated assets, creating a search for value that silver fulfills. Currency management and reserve policies actions that impact currency confidence, such as foreign exchange interventions or reserve reallocation, can influence silver demand indirectly. Silver reacts to the perception of monetary stability rather than immediate industrial consumption. Silver's price is deeply interconnected with gold and broader global financial systems. Gold serves as a primary reserve asset and first responder to systemic stress. Silver, due to higher volatility and smaller market size, confirms the magnitude of systemic strain. When silver spikes relative to gold, it signals acute stress in liquidity, leverage, or currency confidence. Global market interactions also shape silver dynamics.